Have you ever seen a massive trend just take off without you, and you're left on the sidelines, feeling like you completely missed the boat? You want to get in, but you know chasing it is probably the worst thing you could do. Well, today we're going to dive into a really powerful technique for joining those huge moves long after they've already started, and we're going to do it without the chase.
Welcome to AI Explains ICT. In this video, we are breaking down the core concepts from ICT's Core Content, Month 5, Episode 17. This one is all about limit order entries for long-term traders. Seriously, you're probably going to want to grab a pen and paper for this because we're about to lay out a framework that you can use for years to come.
Okay, so let's start with the big problem that every single long-term trader runs into. You spot this huge, powerful trend, but it feels like the perfect entry point was weeks, maybe even months ago. So what do?
That's the million-dollar question, isn't it? That fear of missing out, or FOMO, it's so powerful. It pushes a lot of traders into making really impulsive decisions. But you know as well as I do that just jumping in blindly, that's a low-probability play every single time.
You know, that impulse to just chase after the price is exactly what leads to buying the absolute high of a move or selling the absolute low. It's so frustrating, and it can be really, really costly. The method we're about to unpack is the complete opposite of that. It's all about patience, it's about precision, and it's about letting the market set up the perfect entry for you.
So how do we actually do it? Let's break this technique down, and we'll start with the bullish scenario. Just imagine the market's in a crystal clear uptrend, and we need a disciplined, low-risk way to climb on board.
The framework here is just beautifully simple, and it follows 4 key steps. Number 1, it all starts with context. The big picture on your monthly and weekly charts has to be bullish. No exceptions. Once we've confirmed that, we move to step 2 and patiently wait for our signal on the daily chart, which is just a single down close candle. That's it. That bearish candle is our cue for action, which is step 3. Place a buy limit order right at that candle's close. And the logic here is absolutely brilliant. We are using a very brief moment of short-term weakness to get in at a deep discount, right in the middle of a powerful long-term uptrend.
And you can see it perfectly right here. The market is trending up, we get that one down close candle, and we set our buy limit right at the close and just wait. The whole idea is that the market will dip just enough the next day to pick up our order at that really great undervalued price before it continues rocketing higher. It's a method that's designed to give you almost immediate positive feedback that you're on the right side of the institutional order flow.
Of course, this exact same logic works perfectly in reverse for bearish trends. So let's flip it around and look at how to sell short at the most optimal price.
The logic here is just a perfect mirror image of the buy setup. Our high time frame context has to be bearish. Then we wait for the opposite signal, a bullish, up-close candle on the daily chart. Our action is to place a sell limit right at that candle's close. We're essentially selling into a moment of temporary strength at a premium price, an overvalued price, right before that big downtrend is expected to kick back in.
Now listen up, because this next part is absolutely crucial for increasing your odds of success. We are not just selling any random up-close candle. According to ICT, this setup is at its most powerful when that little daily rally pushes the price up into a daily PD array. Just think of this as a predefined zone of resistance where big sellers are likely waiting. This could be a bearish order block, the last up candle before a big sharp down move, or it could be a significant price gap. Getting this confluence is what turns a good setup into a truly great one.
And here's the sell setup in action. You see the market gives a little pop higher, forming that up-close candle. We place our sell limit right at the close, fully expecting a small push higher the next day to fill our order before the major downtrend resumes. You're basically catching that last little bit of optimism right before the sellers come in and take back control.
All right, theory is great, but let's see how this actually plays out in the real world. We're going to take a look at a massive trend in the Japanese yen that happened back in 2016.
First things first, the high time frame context. This is the weekly chart. The expectation, based on institutional order flow, was for the price to rally from this bullish order block down in the discount zone, which is marked in blue, all the way up to that bearish order block in the premium zone, marked in red. This gave us our long-term directional bias. It told us we are looking for buys.
So now, let's drop down to the daily chart and see how this actually unfolded. With our bullish weekly bias locked in, all we're doing is hunting for those down close candles. Every single one is a potential opportunity. And look right here in September. After a nice little pullback, a buy limit at the close would have put you right in the game.
And what a game it was. That very first entry offered a potential move of a staggering 1,800 pips, all the way to that long-term target. I mean, that is the incredible power of catching these moves on the higher time frames.
But what if you missed that one? Hey, no problem at all. The market is generous. In November, it offered another textbook setup after a pullback, and this time it was good for a potential 980 pips.
And guess what? It happened again. Another clear, down-close candle presented an entry for a potential 785 pips. Are you starting to see the pattern here? It's not about being perfect and catching the exact bottom. It's about being patient and being prepared for the opportunity when it comes to you.
Even as the price got closer and closer to its final destination, the setups just kept on coming. 600 pips, 500 pips, even 360 pips were still there for the taking. The really crucial point here isn't just about the numbers, it's about the consistency of the opportunity. You do not have to catch the exact bottom to profit massively from a trend.
So what's the ultimate lesson in all of this? It's not about some complex indicator or staring at your screens all day. It's really about a fundamental shift in your entire mindset.
This question, which comes right from ICT's chart, it just says it all. After you see potential gains of hundreds, even thousands of pips on a daily chart, it forces you to stop and reconsider that assumption that you need to be trading on 5-minute or 15-minute charts to be profitable. The opportunities on these higher time frames are absolutely immense.
So let's bring it all together. The biggest lesson here is that you don't have to be glued to those tiny time frames to find huge profits. This technique gives you a systematic framework, a way to join the market's most powerful trends without all the fear and the risk that comes with chasing. It really all boils down to patience, waiting for the market to offer you that perfect discount in an uptrend or that perfect premium price in a downtrend. This provides clear, low-risk entries time and time again.
If you found this breakdown valuable, please do us a favor and like this video and subscribe for more deep dives into ICT's concepts. And if you have any questions at all, drop them in the comments below. We read every single one and a human will get back to you. Until next time, good luck and safe trading.